No business plans just to break even. So profit doesn't happen by mistake. We need to plan for it. So now our salesman looks at the time, effort, investment that he has to make in his business, and he sets a desired rate of return. In our case here, our salesman desires to earn a profit of $4,900 per show. So we're going to use CVP to determine how many units he has to sell to reach his desired profit. We can then take that to determine the sales dollars that he needs to make this profit. And we'll just confirm it using a contribution margin income statement. So we're going to modify our CVP equation that we used for break even, and we are going to include the profit along with the fixed cost. So we're going to take the fixed cost, and to that we're going to add our desired profit. We're going to divide that by our contribution margin per unit that we determined earlier in our first break-even analysis. So now let's apply this formula to our problem. In our problem, we have fixed costs of $5,600 per show, and we're going to add in the desired profit of $4,900. Our contribution margin per unit was calculated in our first part of the problem, and we determined that the contribution margin per unit, the sales price of $350 less the variable cost of $210, equaled $410. Now we use that to get our results. We'll take the $10,500, divide it by $140, our contribution margin, and that tells us we have to sell 75 units to cover all our costs and earn a profit of $4,900. So what does this equate to in sales dollars? Well, our selling price, remember, was $350. We need to sell 75 units to meet our budget. So our sales in dollars will be the sales price times the number of units we need to sell to achieve our budget results. And that will equal 26,250. So let's check that using the contribution margin income statement. Our sales we just determined is going to be 26,250. From that we need to subtract out our variable costs, and our variable costs are equal to the number of units that we plan to sell times the variable cost per unit, which is given at $210 per set. So our variable cost will be $15,750. We then simply subtract the sales from the variable cost. Our contribution margin, $10,500. We had fixed costs of $5,600, which means our net income is our contribution margin less our fixed costs, or $4,900, which is our desired profit. Again, this is a useful planning tool. We'll be using it throughout cost accounting and when you get into business strategy and putting together your business plans.